All right, welcome to the Explainer. Today, we're going to tackle a huge question, one you've probably felt yourself. Why does our economy feel so unstable? Swinging from boom to bust. To really get to the bottom of this, we're going to dive into the incredible work of economist Professor Richard Werner, whose findings pretty much flip everything you thought you knew about money and banks on its head. It all starts with that feeling, right? That our economic system just seems to lurch from one crisis to the next. It feels like a permanent feature of modern life. But here's the thing. Does it really have to be this way? And whenever these crises do hit, the explanations we get from the experts, well, they often feel a little weak, don't they? After something huge like the 2008 crash, the standard theories just couldn't really explain what happened, leaving most of us with way more questions than answers. And to top it all off, here's a real head-scratcher. For decades, there was a predictable link between the amount of money in the economy and economic growth. Then, in the 1980s, that relationship just fell apart. It created this massive anomaly that totally stumped the experts. Okay, so let's be clear, these aren't just vague feelings. These are well-documented, unsolved mysteries at the heart of economics. Big questions like, what makes banks so special anyway? Why do we have these crises over and over again? And what is the real link between money and the economy? To crack these puzzles, we have to go back to basics. I mean, really basic. What are banks, and where does money actually come from? I'll give you a hint. The answer is probably not what you were taught in school. So Professor Werner did something pretty amazing. He actually went out and empirically tested the three main theories of banking. The results? Well, they're a bombshell. The two theories taught in pretty much every economics textbook, the ones that say banks just lend out savers money, were proven to be factually wrong. The only theory that matched the real-world evidence was something called credit creation. And this discovery reveals an absolutely staggering fact. Get this. 97% of the money in our economy isn't created by the government or the central bank. It's created by commercial banks every single time they make a loan. So how on earth does that work? It's simpler and frankly weirder than you think. When a bank gives you a loan, it doesn't take money from a vault. It just types numbers into your account. In that instant, new money is created, literally out of nothing. The loan becomes an asset for the bank, and the new deposit in your account becomes a liability for them. Let that sink in for a second. This means banks aren't just middlemen moving existing money around. They are the primary creators of the money that fuels our entire economy. Their lending decisions literally determine how much money exists and where it flows. Okay, so if banks are creating all this money out of thin air, the next massive question has to be, what is all that new money being used for? Because as it turns out, not all credit is created equal. And this is Werner's most powerful insight. He realized you have to split all bank lending into two different types. First, you have real economy credit. This is the good stuff. It's money that funds new businesses, new factories, things that actually grow the economy and create jobs. Then you have financial credit. This is money used just to buy existing assets, like stocks, bonds, or real estate. It doesn't create new value. It just shuffles ownership around and pushes prices up. Now, watch what happens when you start looking at the economy through this lens. This one simple distinction starts to unlock all of those mysteries we began with. The evidence is just incredibly clear. You can see it right here. When you chart the credit going into the real economy, it moves almost perfectly in sync with GDP. It drives real growth. But the credit used for financial transactions, it just tracks asset prices, blowing up massive bubbles, and then, you guessed it, causing them to crash. And remember that baffling mystery from the 1980s? That moment when the stable link between money and the economy just seemed to break? Well, this theory solves that puzzle too, because it turns out there was no mystery. The model wasn't broken. Economists were just measuring the wrong thing. All that supposedly missing money from the economy was being pumped into financial speculation. Once Werner isolated only the money being used in the real economy, the relationship with growth was shown to be perfectly stable, just as it had always been. So, what does this all mean? Well, if the allocation of credit, where the money goes, is what truly matters for a stable economy, then that suggests a powerful and completely new approach to how we manage things. It's a playbook that looks very different from what central banks do now. Instead of using clumsy tools like interest rates, the solution is something called credit guidance. It means you stop focusing so much on the price of money and start focusing on its quantity and purpose. You actively steer newly created money toward productive businesses that create jobs and sustainable growth while putting the brakes on credit for unproductive speculation. And hey, this isn't just a theory. There are real-world examples. Look at Germany's famously stable economy. It's supported by a system where nearly 70% of banks are local, not-for-profit community banks. Their whole mission is to provide productive loans to the small and medium-sized businesses in their local areas. And just in case you think this is all hindsight, listen to this. Using this exact framework, Professor Werner predicted the nature and the severity of the 2008 financial crisis in his 2001 book. That was a full 7 years before it happened. He saw it coming. So, this is what it all comes down to. The private, day-to-day decisions of a few large banks about where to point the fire hose of newly created money can literally determine our collective economic fate. They can create either stable prosperity for everyone or devastating crises. And that leaves us with one final, profound question. Who should really be in control of that power?